Well, welcome everyone. Thanks for joining us. I'm Vlada Tirenina, Head of Growth at Intersog, and I'm thrilled to host this conversation. So we'll talk today about how AI can be a strategic value creator for your company, especially when it comes to raising capital and or selling your business. So we have a stellar lineup of speakers today. So we are doing this webinar in partnership with Capital8X, and our main speaker today is Tim Kogan, co-founder and managing partner at Capital8X. And Tim comes from the world of mergers and acquisitions and strategic finance with over 15 years of experience. He has contributed to over 1 billion in enterprise value across 30 projects in the United States and Europe. Tim, welcome.
Hi, Vlada.
Pleasure to have you here.
My
And we
pleasure
also
having me.
we also have our second panelist is Igor Fedulov, CEO of Intersog. Intersog works with companies in fintech, healthcare, and other regulated industries to turn technology investments, including AI, into measurable business outcomes. And Igor brings 20 years of experience leading complex projects, software and data initiatives projects, advising organizations on how to scale technology in a way that supports growth and operational efficiency. And he's also a member of Forbes Technology Council. Igor, glad to have you here.
Pleasure to be here.
So, before we dive into our panel discussion, so a few housekeeping notes. We have a Q&A session at the end, so you can drop your questions anytime in the chat or in the Q&A section, and I'll bring them to Tim and Igor at the end. Also, this session is being recorded, so if you don't feel comfortable that it's being recorded, please drop off at any time. And I will do the recording of the webinar and it will be sent to your email after we're done. So let's dive into our discussion.
So why don't we structure the team was I'm going to ask you some curious and tricky questions and you're going to answer them. How does that sound?
That sounds amazing. Sounds great to me. Um,
Okay.
Let me first make sure I can share my screen if you can see it.
Yep.
So
Perfect.
can you see now?
I can see your screen.
It's amazing.
Yeah.
Before we start, let me first say Hag Pesach Sameach to those who celebrate. Hope you guys enjoy the Pesach and have nice Passover evening this week. Yeah.
Thank you.
Thanks.
Okay, so I want to start from having conversations with a lot of business leaders. Like every company under the sun now claims to have an AI strategy. I think it's like a trendy thing to have, Lululemon pants at some point of their life. So we're seeing AI mentioned in every single pitch deck, in every IPO filing, in the S1s. There's my skeptical question. If everyone is talking about AI, does it actually move the needle on the valuation of a company, or is it just a hype? And what can you tell us about it?
Um, just first, let me know if you can see the deck now. If you drop a comment if it's visible. All right, perfect. Igor, thanks so much. Great question. And I would say that the short answer is it's both. Having an AI story is absolutely table stakes now. 100% of US IPOs in 2025 referenced AI in their S1 filings, as you mentioned. If you show up to an investor meeting without an AI narrative, you're already behind. But here's the thing, I think it's very important. Having a story is not the same as having a proof. And the market is very clear about this distinction. Um,
Interesting.
Look at what happened in public markets. This is 2025, 2026 data. On the left, company that went deep on AI transformation. Salesforce pivoted Agentforce into 800 million in revenue. Palantir is up 55% just this year. On the right, company that shipped AI features but couldn't prove AI-driven revenue. Atlassian down 57%, HubSpot down 40%, Monday.com down 73% over the past year. And it's the same macro environment for everyone. Same interest rates, same customers, completely different outcomes. The market is pricing in whether AI is actually in the business model or it's just in the press release. And it isn't just a public market phenomenon. Let me show you the foundational case where what this looks like in private M&A on example of Qualitest. This is where it all started. That's why it's so important to be familiar with this case. Qualitest is a software testing company, roughly $100 million of EBITDA, PE owned by Bridgepoint in UK. They went to market in 2023 expecting an AI premium, and their logic was pretty, sound. AI will reduce engineering headcount, drive margin expansion, enable outsized growth. But the buy side heard a completely different story. They said, okay, AI is a business model risk for headcount QA business like Qualitas, and you have no visible proofs of AI impact. So we are applying a discount, not a premium. And the process was halted. $1 billion plus asset couldn't bridge the gap between AI growth and AI risk. And this is the core insight. If you cannot prove and price your AI impact, the market doesn't give you zero credit. It gives you negative credit. The absence of proof becomes a discount. So that's answering your first question, Igor.
Okay, so the market clearly knows how to value companies, given your examples of Palantir going up and Monday.com going almost 80% down by now. But what exactly does investor or buyer then look for? Like when all across the table from sitting from a PE firm, like what do they actually need to see before the price an AI premium? How does one go about this?
Actually, three things must be true simultaneously. Think of this as the three tests your AI story has to pass. First, impact has to be financially quantified. Not we are using AI across the organization, but here's our AI capital budget with IRR, NPV, payback period, CapEx, and OpEx breakdown. You need to speak the language of finance, not the language of technology. And it needs to be supported by a clear, articulated AI strategy, not just a slide in a pitch deck, but a real operational plan. Second, your AI impact has to outperform market benchmarks. Investors aren't impressed that you're using AI. Everyone is. They want to see that your results exceed what the market is doing. And this needs to be underpinned by demonstrating AI know-how that your organization possesses, meaning your team has actually done this, not just bought a subscription. And the third one, and this is the one most people forget, it has to be defensible and transferable, meaning that if your capability walks out the door when two engineers leave, it's worthless to a buy, right? It needs to be documented, packaged, embedded in systems and processes with dedicated talent and organizational capability in place. When any of the three fails, buyers assign no premium, and as we saw with the Qualitest case, they may actually penalize the valuation. And now this naturally leads to the next question. Okay, what must be true? We understand, but when do these things become true? And that's where we develop the talk, walk, report framework. Actually, we meaning talk the investor, walk the investor, and report to investor. Talk is where most companies are when they come to us. Basically, you can articulate the AI case, you have a strategy, you have a projections, maybe you have a financial model. This gets you protection from AI discount narrative. Very important. It gives you protection against AI discount narrative. It shifts the conversation from this company has AI risk to this company has AI upside potential. Walk the investor is where real value starts being created. So this is when an investor or a buyer can physically during site visit see AI-powered process during due diligence or site visits, like I said. They can walk into your operation room or into your AI excellence center and see it working. They could see part of your product code being developed with AI. This creates the basis for earnout structures and real buyers' confidence. Again, earnout, not the price increase. And the third one is report, which is the end game. Of course, it's natural when AI impact is reflected in your financials, margin improvement, revenue accelerations. It sits in the numbers. So at this point, it's fully priced in enterprise value. And the practical takeaway for those who are listening, most companies enter transaction at talk. So you should not be entering the market, initiate conversations with investors without having at least stock, meaning without having at least this set of documentation that supports your AI case. The goal is to reach at least walk stage in 3 to 6 months before you go to market, already kind of establishing access to due diligence rooms for investors. That's the window that makes the difference. So yeah, Igor.
Interesting. Okay, so then let's play this. For example, you're a CEO or a CFO, and you're preparing for next round of board meeting where potentially you're gonna get a raise. Like where should you focus your AI investment? Like what you should be thinking about? It looks like these options are really in abundance right now, from anywhere from Copilot to you name it. Now it's desktop-based coding agents.
Yeah, absolutely. Let me show you. This is our tool that we invented, developed. We call it the C8X AI Compass. We built it on the foundation of value enhancement frameworks used by activist investors, notorious for being very good at driving valuations of businesses they invest in. Particularly, we used Damodaran's work at NYU Stern and adapted it for AI transformation. As you can see, the matrix shows 4 levers through which AI creates enterprise value and how their potential changes depending on your company's life cycle stage. The numbers represent indicative EV uplift as a percentage of current enterprise value over 2, 3 years of hold period. And a few things to notice here. Capacity enablement gives you the highest uplift for the growth stage companies, up to 25%. That's because you're not just saving money, you're removing the bottleneck on growth. For mature companies, cost optimization is the most reliable lever, up to 18%. And look at platform foundation for startups. It's actually negative 5%. And this is not a mistake. If you're investing in AI infrastructure without tying it to a specific cost out or growth initiative, it's pure expense that drags down valuation. We see this frequently, companies building AI platforms because they feel they should without a clear business case, and they are not additive, by the way. You can just sum them, this effect up, but the right combination of 2 or 3 levers sequenced properly is what produces 15%, 25% EV uplift we are talking about. Now, I know that what some of you are thinking, what about building AI products? This is like very important. And the answer is yes, of course. AI native revenue commands a premium, 100%. Look at Palantir, 142% stock appreciation, 51% operating margin. Salesforce agent force, like I mentioned already, hit $800 million in revenue. So that's extraordinary growth. But here's the other side that you should take into consideration. Companies that bolted AI features onto existing products got penalized. HubSpot shipped over 200 AI features and stock dropped 40%. 200 AI features. The market doesn't reward AI announcements, guys. It rewards AI revenue. And for most companies approaching a capital raise or exit, building an AI native product probably is not the fastest and probably not the safest path. It has the highest execution risk and the longest payback. If you're a software company with right capabilities, absolutely explore it. But for the majority of mid-market businesses, operational AI is probably the most predictable and reliable and also faster path to premium. And which bring us to 2 major operational levers. On the left, you can see capacity enablement. Basically, you free up most expensive people to take on more work without additional headcount. That free capacity gets reinvested into growth, basically, accelerating revenue, expanding market share. Valuation impact is high because it drives both margin and growth simultaneously. On the right, cost optimization. You automate routine activities, improve margins. It's the most consistent short-term value from AI, but the impact is moderate because efficiency gains are, this is important, transitory. Your competitors will eventually adopt the same tools and your margin advantage would go away. Therefore, the smart sequencing is start with cost optimization, generate extra cash flow, quick wins, prove the model works, build organizational confidence, and use those savings to fund capacity enablement initiatives that drive long-term terminal value. Igor?
Interesting. This is quite a lot of to consume. And then I guess from my point of view, it's a great in theory because a lot of projects that we were involved in is that not as easy to find cost savings, and but all of it is doable. So in practice, like I've seen companies spend millions on like Copilot of the world, and they have nothing to show for. Like they pay for licenses, but barely anyone uses them. So what goes wrong, and how do you design an AI initiative inside of your organization that actually sticks?
Yeah, in our experience, 5 things consistently go wrong. And I'd say we see at least 3 of this in almost every company we face. Number one by far, is fragmented implementation. So basically, companies apply AI to one piece of the process and expect magic. What actually happens is just bottlenecks just moves. Those who are familiar with theory of constraint, they would understand. You speed up for instance, you speed up code generation, but testing becomes the constraint. You automate documentation, but your review process can't handle the throughput. So AI has to be integrated end to end across the life cycle, or the gains evaporate. You don't see them in your cash flow. Number two, insufficient immersion in complex activities. So most AI tools work great on simple, innovative, repetitive tasks when you do something new. But the high value activities, when architecture decisions, complex scoping, cross-functional coordination, they require deep context awareness. And companies underestimate how much prompt engineering, workflow design, and human AI collaboration it takes to crack these things. And number three, broken capital budgeting. Again, on the financial side, many associate AI transformation with technology project, IT project. So finance people rarely get involved, and often CEOs get excited. So they kind of accept losses. And I hear a lot of, heard a lot of time that we should accept losses. I disagree. I say that, and many companies eventually either refuse to invest properly because they can't quantify the ROI, or they overspend without clear cost structure. But either way, CFOs can defend the narrative to a board or a buyer or investor, of course. Number four, short-termism. Of course, some CEOs very concerned about EBITDA improvement this quarter, so they just cut headcount, pocket the savings, and call it a win. But as we'll see in a moment, that captures only a fraction of the potential value. The real price is in growth reinvestment. And number five, good old team resistance. People are worried about their job security. They're skeptical. They've seen, transformation initiatives before. If you don't address this directly, adoption stays low, and you would face what we call, for instance, compliance theater. You would be thrown with a bunch of different reasons why they should not be switching to AI native workflows, but eventually it's still just good old team resistance. So we designed 4 principles specifically to address these failure modes, so that it could serve as a guideline for those who are dealing with implementation of AI. And there are 4 of them, like I said. 1, target cash flow critical life cycles, meaning don't do AI for the sake of AI. Identify processes that are material to your P&L and quantify the impact using proper capital budgeting, NPV, IRR, payback, all that boring stuff. Speak finance, not tech. Second principle, transform processes end to end. This directly addresses the fragmentation problem I mentioned earlier. If AI touches every step of the process, you eliminate bottlenecks instead of shifting them. You improve capacity of the entire life cycle. 3, only build custom AI around your existing margin drivers. Use off-the-shelf enterprise tools for everything that's commoditized. Save your custom development budget for the things that actually differentiate your business. Work with companies like Intersog for that, but the capabilities that won't be competed away. And 4, reinvest AI gains into growth. This is critical. This is the terminal value play. Don't just take the savings, convert them into revenue acceleration at high return on capital. That's where the compounding happens. Everybody heard about the magic of compounding effect. This is here. So yeah, Igor.
Great insights. So let's assume all of that happened and we're getting practical now. So how do we then transform this into value? What is this all work impact in the AI implementation and full cycle? Um, Walk us through that.
Absolutely. So basically, you need to follow 6 steps. And I want to emphasize it's not some kind of a consulting framework where we brainstorm at a whiteboard. Each step process is a has a quantified output that fits the next one. For instance, step one, we select the target process. This is where we start. We score your major processes on 5 criteria. How material is it to your P&L? How directly is it linked to growth? How mature are the AI tools available? How standardized is the process? And how technically ready is your organization? And I will use the SDLC, software development lifecycle, or software R&D, because it's as an example, because it's the most mature case with the best benchmarks. But the same scorecard works for sales operations, customer support, financial close, any P&L material function. So, for instance, you can see the scorecard here. The weights matter. Materiality and growth linkage are weighted 2 times because financial impact is what drives valuation, of course. A process that scores high on AI tool maturity but low on materiality basically is a science project, not a value creation initiative. And for instance, for SDLC specifically, as you can see, for many companies and SaaS companies, it's 20-30% of their P&L. For instance, this is how we break down the function into 8 distinct activities with clear time allocations, again, using SDLC as an example. For each activity, we map specific AI use case and tools, like, for instance, GitHub Copilot for code development, to, for instance, AI-driven test generation, to automate the documentation. And then when you run the numbers, the weighted productivity potential across all software development activities is approximately 30%. But that's gross savings, the potential maximum. The real world, as we all know, is messier. So step 5 is where we adjust for instance, for seniority mix. Not everyone benefits equally from AI. Senior leadership gets essentially 0 direct productivity gain. It's clear. Their job is judgment, relationship, strategy. Middle management sees maybe 50%. Individual contributors, the people actually writing codes, tasks, documentation, that's where you see the full effect. And after this adjustment, your 30% gross comes down to 25% net realizable, taking into account, of course, stock-based compensation, et cetera, et cetera. And that's before implementation costs. Now, if you look at implementation costs, we should categorize, and this is our approach, AI tools into 3 tiers based on integration depth and adoption complexity. What we call small tools, they usually plug into existing platforms easily. Companies and people start using them naturally. They normally have no disruptions toward workflows. So like meeting assistance, maybe summarization, email drafting, something which is very simple. Medium, and they normally don't require that much of an upskilling. Medium tools, they could be a little bit more advanced, so they require API integrations and domain-specific configuration, adaptation to your context. Here, it's very recommended, so you kind of train your people to use those tools. And the large tools, they hook into core infrastructure, and need enterprise level security, dedicated AI operation support. And it requires heavy training and coaching of your people with substantial change management. So lots of overall kind of implementation processes happening for integration of those tools. And also they're usually very focused on specific problem or specific narrow part of your life cycle. For our SDLC example, based on our calculation, it's roughly $25,000 per employee, SDLC employee, of initial investment, and $10,000 in annual recurring cost. After all costs, of course, these initiatives are in NPV positive, so payback roughly of about 2 years. And yeah, so that's the practicality mechanics, operational mechanics of the implementation.
Interesting. Okay. So so then basically we identify those costs per employee, we identify the savings. Then how does that, the hard part now, what's how the company valuation um, gets higher? That's, I
Yeah,
guess that's would be my question.
I'll walk you through the financial model. Just, this, I don't want to bother everyone overwhelmed
Yes.
with Excel spreadsheets, but just to give you an idea. So financial model works in three layers. First, we of course take your existing business plan, if you have one, which is not always the case, but we take your existing business plan, or you should develop your business plan and build a baseline valuation. So that's your standalone forecast, revenue, EBITDA, cash flow, enterprise value through DCF or multiples. So we need to understand the fundamental value of your company as is. Second, and this is the key, we overlay the AI transformation layer that we have just calculated. So this takes productivity gains that, as we calculated them, net them against implementation costs, apply tax, and that produces what we call AI transformation NOPAT, the net operating profit after tax attributable specifically to AI. And third, we model the AI case. Basically, we model reinvestment of that AI NOPAT into growth at your company's historical return on capital, and the accelerated revenue, expanded EBITDA, and the resulted AI adjusted valuation. And the critical point here that the model isolates AI's incremental contribution, and a buyer or investor into your company, into your business, can audit it independently from your baseline. So that's what makes it defensible in a transaction. But here is where the most important strategic decision happens, and a lot of speculation happens. And even just people who are not familiar with the transformation are afraid of people being laid off, etc. So you created 30% free capacity. What do you do with it? This is the question. And you basically have two paths. So path A, the efficiency play. You cut headcount. You let people go, pocket the margin that you improved, show better EBITDA next quarter, but the math works. So basically, your EV now, enterprise value, is EBITDA plus savings times your base multiple. Simple. But according to our calculation, it only captures only a fraction, maybe 1/5 of the total value potential. Why? Simple, because in the long-term perspective, efficiency gains are transitory. So your competitors eventually adopt the same tools, the margin advantages would compress, and you're exiting a smaller company with temporarily higher margins. This is very important. All the margin improvements coming from efficiency plays, including AI transformation, are transitory in the long-term perspective. The only thing that is not transitory is basically path B, the terminal value flywheel. What it means that you keep the headcount. You do not let people go. This is your team. They know how to work. They created bond with each other. So you keep the headcount, but redeploy the freed capacity into accelerating your product roadmap and market expansion. So basically, you're converting virtual headcount into incremental revenue at high returns on invested capital. This captures approximately 80% of the potential value. Because revenue growth compounds, we all know again the magic of compounding, you're exiting a larger company with higher growth, which commands both higher EBITDA base and higher multiple. Higher EBITDA base and higher multiple. And here's what it looks like in practice. This is a real model based on a mature PE-owned B2B SaaS company. The revenue, it's a historical case. Revenue is roughly $250 million. EBITDA roughly 43 million. Annual spend on SDLC on R&D is roughly 46 million. And as you can see, baseline enterprise value is roughly 1.1 billion at 4.5 times revenue multiple, 26 times EBITDA multiple, already pretty high. It was. And after AI transformation, with the growth reinvestment path, the company's valuation went up to 1.4 billion. That's 24% uplift and 270 million in incremental enterprise value. That's a lot of money. And on an initial investment of roughly 12 million into AI transformation. So you invest 12 million and you get 270 in incremental enterprise value. That's quite amazing, I guess. So the internal rate of return for this investment is roughly 160%, 160%. NPV in the forecasted period is roughly 33 million, but paid back in year two. So, and as you can see, operational metrics go down as well. For instance, your revenue growth rate goes from 10% to 16%. EBITDA growth rate goes from 22% to 30%. R&D in a baseline scenario as a percentage of revenue actually drops from 20%, which is normal level for SaaS companies, to 16%. This is so. Can you imagine only 4 percentage points in your P&L converts into 270 million of enterprise value uplift, and with the same team. And so basically, and it's important as well, linking to what I told previously, the reinvestment flywheel adds 383 million to terminal value. If you discount it, it's going to be 216. That's where the real money is. This is what you can articulate to investors. And private equities, they're notorious, for instance, for playing this long-term game. So that's the financial mechanics behind it.
Interesting. Very interesting. All right. Well, there's a lot of information, and I wanted to just before I go, because I have so many questions, but I want to keep everybody's time. So, if you want to take one thing away from this discussion, like what would that be? Like just one thing. What
Sure.
important action?
Actually, it's not going to be one thing, but I'll try to keep it short.
Okay.
I'll give the I'll give the takeaway and the practical steps. So the framework that I've been discussing in the beginning, talk, walk, report, is actually your roadmap. So, and both Capital-Atix and Intersog are structured to help you move through it. So at the talk stage, Capital-Atix run the AI Compass diagnostic we showed you. We identify your highest value AI lever, build a financial model, and produce an investor-ready AI value creation plan. This is what shifts the narrative from discount to upside. At the work stage, Intersog executes the implementation, develops amazing custom AI solutions, end-to-end AI integration across the target processes, tool selection, deployment, optimization, team coaching, all that stuff. They design pilots specifically for due diligence visibility. So when a buyer walks in, when you walk a buyer or an investor, they see AI in action. And at the report stage, we work together with Capital-Atix and Intersog on the financial tracking and transaction-ready documentation. Intersog on the operational KPIs to make sure AI impact is fully captured your financial and defensible through the deal process. And here's one takeaway, finally. AI premium is earned, it's not assumed. 3 conditions have to hold. The impact is financial quantified, it outperforms benchmarks, and it's defensible and transferable. The single most important thing you can do this quarter, figure out where you stand. Are you at talk? Are you at walk? Or are you at report? And what the gap between where you are and where you need to be before your next transaction, before you're talking to investor, before you're talking to potential buyer. And for you, of course, we're offering a complimentary 30 minutes AI Compass session. We would be more than happy to walk you company's profile right against the Compass, tell you where AI can create the most enterprise value for your specific situation. No commitment. So it's not a pitch, just a diagnostic. So if it's useful, we'll talk about the next steps. If not, you walk away with a clear picture. So yeah, thank you. Thank you, Igor.
Awesome. Thank you, Tim. Very informative. Lada, over to you.
Yes, thank you, Tim. It was an amazing conversation, and I think we have a couple of questions. So first of all, there is a question from Elena. Will there be a presentation share? And yes, we'll definitely share the presentation with everyone who needs it. Yes. So let me see if there are any other questions from the audience. And if you didn't have a chance to send your question to the Q&A section or the chat, please feel free to do it right now. Okay. Well, I'll give a couple of more minutes for like if anyone wants to ask any questions. If today's session resonated with you and you are like you're wondering what to do next and where your company stands, so Intersog and Capitalytics like has an offer, a joint offer, AI profitability discovery, and it's exactly the kind of diagnostic the team described today. So I'm just going to drop the link here in the chat as well, and you will get it by email as well. So just a second. I don't see any other questions so far.
As professors say, no questions when everything is clear and nothing is clear. So we hope that everything is clear.
Yes, there is one question from Sergey. So are there any AI levers that every company should deploy?
That's probably going to be a question for you because I can think of many, but I don't want to be talking about the Atlassian case with their approach to streamline the document processing and correspondence. Those things come naturally. There's a lot of tools out there, but they not necessarily result in increasing the bottom line.
I would advocate kind of like against like universal AI approach. Of course, we have this AI for office work, and as Igor mentioned, that definitely should be adopted by everyone. But when it comes to value creation, when we talk about improving valuation of a business in conversations with investors and buyers, I wouldn't say there is like one silver bullet that could improve valuation of any business. The only probably caveat would be that most of companies now heavily exposed to software development. Even if you are not a tech company, you still might have a pretty substantial R&D department or work with external providers who develop custom software for you. And normally that could be quite a substantial amount of money, given at the scale of your P&L. So that would be the easiest and probably the quickest win, I would say, for most. But imagine you have like, I don't know, 5% of your revenue is spent on software development. If you improve it by, I don't know, 20%, it's going to be only 1 percentage point of your total P&L that translates into valuation enhancement. Still substantial, but it's not going to be like something that much visible. So therefore, I'd say it requires pretty substantial individual approach. You should be well aware of what you're doing. And like I said, your finance team, strategic finance team should be involved, not just your IT team. That would be my answer.
Mm-hmm. Thank you, Tim. One more question. Can you bring some examples of AI as a cost enabler?
Cost enabler? In many companies, it's a cost enabler. In most of the company, or I guess the question was about the growth enablement, right?
And AI cost optimization for premium creation.
Yeah, of course. So again, I will bring up the software development life cycle. This is the easiest one because in SaaS companies, software businesses, this is definitely the highest growth enablement part. Because if that was the question, so because basically, in order to
Sorry, Tim. There's one more thing. Sorry, any practical experience which can be brought as an example, cases with AI capacity enabler decisions and AI for cost optimization, industry solution, and real premium creation and how it was reinvested.
You can email me and ask this question. I believe the entire, it would be a very long answer, but I think the entire presentation was about it. And if you want, like I said, SDLC, software development life cycle, for many companies, it's both capacity enabler and cost optimization drivers that are essential for revenue enablement. If you want some other industries, we can talk about other industries, but it's very individual.
Great. I think that would be great to follow up. Perfect. I don't see any other questions. Please let me know if anyone is still expecting an answer, and we'll be glad to follow up. So after this webinar, you're going to, if you need the recording of the webinar, if you need the presentation, the actual slides of the presentation, please let us know and we'll send them by your email. And of course, any resources that I mentioned, we're going to share with you by email as well. So I added in the chat, in the webinar chat, I just added the link with the joint offer that Capitalytics and Intersog are doing. So I just wanted to say thank you to everyone. Is there anything, Tim and Igor, you want to mention for our listeners?
No, thank you for attending, and have a great Junior Friday, as we call it in our organization, because it's almost Friday.
Good luck, everyone.